Given the recent economic volatility and the shift in the real estate market cycle, the most common question I get asked is what happens to cap rates when interest rates rise? In this video, I'm going to show you. What if I told you there is a powerful indicator that can help you understand the value of a real estate investment? It's called a cap rate, and you'll find out exactly what it is in a moment. I'm going to show you exactly why they're so important in real estate and how they're significantly impacted by those interest rates we've all been watching rise recently. Plus, what that means for market dynamics, how properties are valued, and how you are making your investment decisions. Now, once we've gone through a full cap rate calculation step by step, I'm going to dive into how my company, Sunrise Capital Investors, invests with high interest rates in mind. So let's dive in. First, let's discuss cap rates in more detail. In real estate investing, the capitalization rate, also known as the cap rate, is a key metric used to evaluate the potential return on an investment property. The cap rate is calculated as the net operating income, also known as the NOI, divided by the property's current market value or purchase price, expressed as a percentage. This formula for calculating the cap rate is cap rate equals net operating income divided by the current market value. NOI is calculated by subtracting the property's operating expenses from its total revenue. Now, operating expenses include items such as property taxes, insurance, maintenance and repairs, utilities, and property management fees, things like that. Now, total revenue includes all income generated by that property, and this includes rental income, parking fees, laundry revenue, and other sources of income. Now, once the NOI is calculated, it is divided by the current market value or purchase price of the property to determine the cap rate. For example, if a property has an NOI of $50,000 and a market value of $500,000, then the cap rate would be 10%, which is $50,000 divided by $500,000. The cap rate is a useful metric for real estate investors because it provides a standardized way to compare the potential returns on investment for different properties. Generally speaking, the higher the cap rate, the higher the potential return on investment, but this also can indicate a higher level of risk associated with that particular investment. Cap rates can vary depending on the location, type, and also condition of the property, as well as market conditions and other factors. Therefore, it's important for investors to thoroughly analyze the property, its financials, and the local real estate market before using the cap rate to make investment decisions. The reason cap rates are so important is that they allow investors to compare different properties in terms of their potential returns. And by comparing cap rates, investors can determine which properties offer the best investment opportunities and make informed decisions about where to allocate their capital. Now let's talk about interest rates. Interest rates can rise due to a variety of factors, including inflation, economic growth, and monetary policy changes by the central bank. Now, when inflation is high, central banks may raise interest rates to control inflation by reducing the amount of money in circulation. Similarly, when the economy is growing rapidly and there is a high demand for goods and services, central banks may also raise interest rates to prevent inflation from getting out of control. Additionally, changes in monetary policy by central banks, such as the Federal Reserve in the United States, can have a significant impact on interest rates. For example, if the central bank raises interest rates to control inflation, it can cause borrowing costs to increase for consumers and businesses, which can slow down economic growth. Furthermore, global economic conditions and geopolitical events can also impact interest rates. Now, when interest rates rise, it affects market dynamics, property valuations, and investment decision making. Rising interest rates can have a significant impact on the real estate market, affecting both buyers and sellers, as well as the demand for and supply of real estate assets. One of the primary impacts of the rising interest rates is the cost of borrowing. Now, as interest rates increase, the cost of borrowing money to purchase real estate assets also increases. This can lead to a decrease in demand for real estate assets, as potential buyers may not be able to afford the higher borrowing cost. Now, this can also lead to a slowdown in real estate sales and a decrease in property values. Additionally, rising interest rates can impact the supply of real estate assets. As borrowing costs increase, it can become more expensive for developers and investors to finance new construction projects or to acquire and renovate existing properties. All of this can lead to a decrease in the supply of real estate assets, particularly in areas where there is already a limited supply. Furthermore, rising interest rates can impact the overall health of the real estate market. As demand for real estate assets decreases, it can lead to an increase in the number of properties on the market and longer marketing times, which can lead to lower property values. This can also impact the ability of investors to earn positive returns on their real estate investments. Higher interest rates can lead to increased borrowing costs, which may reduce property values, increase cap rates. This in turn can impact the attractiveness of certain investments and force investors to reevaluate their strategies. One way that rising interest rates can affect cap rates is through the so-called spread between the cap rate and the interest rate on borrowed funds. Now, when the spread narrows, it can become less profitable to invest in real estate using leverage, which can lead to reduced demand for properties and ultimately lower property values. If you're enjoying this video and want more tips on real estate investing, don't forget to hit the subscribe button. So the million-dollar question is, how can you mitigate the impact of rising interest rates on real estate investments? One strategy is to secure long-term financing at fixed interest rates, which can help protect you from the effects of interest rate fluctuations. Long-term financing can also mitigate the impact of rising interest rates on real estate investments in several ways. First off, long-term financing such as fixed-rate mortgages can provide stability and predictability in a rising interest rate environment. With a fixed-rate mortgage, the interest rate remains the same over the life of the loan, regardless of any increases in interest rates in the broader market. This can help real estate investors budget and plan for the future, knowing that their monthly mortgage payments will remain consistent and predictable. Second, long-term financing can provide a hedge against inflation. Inflation erodes the purchasing power of money over time, which means that the value of debt decreases in real terms. Therefore, if inflation increases, the amount of debt owed becomes less valuable over time, which can help to mitigate the impact of rising interest rates. Third, long-term financing can provide stability and reduce risk for real estate investors. By locking in fixed-rate mortgages for a long period, investors can reduce the risk of being caught by sudden increases in interest rates that could impact their cash flow or ability to refinance. All this can help investors weather any short-term fluctuations in the real estate market and provide a stable platform for long-term growth and returns. Finally, long-term financing can also provide greater flexibility for real estate investors. By securing long-term financing, investors may be able to hold on to their properties for longer, even in a rising interest rate environment. This can provide more time to identify and execute on value-add opportunities, such as property renovations that can increase the value of the asset over time. Another way to mitigate the impact of rising interest rates is by investing in real estate that has in place positive cash flow. By doing this, you create a stable and predictable income stream that is less sensitive to short-term fluctuations in property values or interest rates. When investing for cash flow, the primary focus is on generating consistent income from rental income or other sources of income rather than on capital appreciation alone. This income can help offset the impact of rising rates on mortgage payments or borrowing costs, ensuring that the investment remains profitable even in a rising interest rate environment. Furthermore, investing for cash flow can provide a hedge against inflation. As inflation increases, rental rates may also increase, providing a natural inflation hedge for real estate investors. Finally, investing for cash flow can help to reduce risk for real estate investors by generating a consistent income stream. Investors can reduce their reliance on short-term fluctuations in property values or interest rates, which can be very difficult to predict or control. This can provide a more stable and predictable investment platform that is less sensitive to short-term market conditions. Overall, investing for cash flow can be an effective strategy for mitigating the impact of rising rates on real estate investments. My company, Sunrise Capital Investors, implements all these strategies outlined and places a core focus on identifying and acquiring undervalued properties in markets with strong growth potential. We then implement targeted value-add strategies to improve property performance and increase cash flow, which can help us insulate our investments from the effects of rising interest rates. We have found that our conservative investment approach paired with a long-term investment philosophy provides a safe and secure investment structure well equipped to weather even the toughest of economic storms. As a thank you for watching this entire video, we've got a free gift for you. We're here to help you with any and all of your passive investing needs. But it's no secret that our favorite asset classes are mobile home parks and parking facilities. It's what we do every single day, and we know it like the backs of our hands. If you want to learn more about what, in my humble opinion, is the best asset class in all of real estate, click the link in the description to get our free guide to mobile home park investing. Don't miss out on this fantastic opportunity to expand your knowledge and improve your investment strategy. Thanks for watching. I'll see you on the next video.